Taxes shouldn't be the main driver of your investment strategy. Ultimately, you want solid returns with an acceptable level of risk. Still, taxes can take a sizable chunk out of your investment returns, so it makes sense to minimize the tax bite as long as you can do so without creating problems for yourself. Fortunately, there are a few relatively simple ways you can do that. One is to invest in index funds or ETFs. Unlike regular mutual funds, which can do a lot of trading that generates taxable gains, most index funds and ETFs buy and hold shares of stock in an index or benchmark. Since they're not constantly trading, they're generally more tax efficient than actively managed funds. You can find several index funds and ETFs on our Money 70 list of recommended funds. Another breed of funds that tend to be very tax-friendly are tax-managed funds, which are managed specifically to reduce taxable distributions to shareholders. For example, the manager may purposely sell stocks for losses so those losses can offset gains in other parts of the portfolio, or the manager may sell high-cost shares to minimize taxable gains. As with index funds, tax-managed funds may not be able to totally eliminate taxable distributions, but they can keep them to a minimum. To come up with a list of tax-managed funds, just type the phrase tax-managed into the quote box at the top of any Morningstar.com page. One more thing you may want to consider to pay your tax bill is to be smart about asset location, or how you divvy up investments between taxable and tax-advantaged accounts. Generally, to the extent possible, you want to keep investments that get much of their return in the form of long-term capital gains, such as broad stock index funds and many ETFs, in taxable accounts, so you can take advantage of the lower long-term capital gains rate. And investments that generate the bulk of their gains in interest payments and short-term capital gains, such as bond funds and actively managed stock funds that trade a lot, you would want to hold in tax-deferred accounts, like 401ks and IRAs. Gains from those investments will face ordinary income tax rates anyway, so by holding them in tax-deferred accounts, you are at least sheltering their gains from taxes until they're withdrawn. By being savvy about asset location, you can incorporate funds into your strategy that you may need, even if they're not the most tax efficient, without giving up much of your return to the tax man.